In this video, I'm anticipating a question. The question is, how does accounting actually work? People are going to see, hey, gee, he's got an entire series on the Financial Accounting Standards Board, and he's never really talked about accounting at all. Well, granted, there's a lot of accounting lessons all over the internet, but people want to learn from me, so fine, here we go. Let's take a guy who is going to make a bicycle shop. Let's say he wants to start his own bicycle repair business. He's going to sell bicycles, he's going to repair them, etc., etc. Alright, well, first of all, he has to acquire some assets. What are these assets? Well, he's definitely going to need tools to work on bicycles. He may even have machines that he's going to have to use to fix the chains on the bicycles, to straighten out wheels, etc., etc. He's certainly going to need a building to have people come in and bring their bicycles so he can fix them up, or he's going to be selling bicycles, so he's going to have a whole bunch of bicycles there to sell off, and so therefore he's going to need a building. Those kind of things are assets, and the reason why you know them as assets is because they're going to be around for a while. I mean, he's not going to use these tools one day while fixing the bicycle and just suddenly chuck them right after that. Certainly, he's not going to start his business and 30 days later he's going to sell off his bicycle building and then move to another one. So that would be an asset. Also, these kind of assets, not a lot of people can suddenly come up with $80,000 to $90,000 to buy a building for their shop. And certainly they can't just suddenly come up with like thousands of dollars to buy their tools so they can work on their bicycles. So often they'll take out business loans, and so they're actually going to borrow money from somebody, and that somebody is going to charge them a certain amount of money each month until they pay back the original money that they borrowed from the person they're borrowing the money from. I know that kind of sounds confusing, but it's just like your car loans. You go out, you buy a car, but you don't have like $30,000 to $40,000 to buy the car, so you borrow money from somebody and you say, hey, I'm going to pay it back a certain amount for a certain period of time, and I'm going to pay you a little extra to hold on to your money until such time as I can get it all back to you. And so that's what a loan is. And these loans, these company loans, are known as liabilities. So you have assets, which are your building, your tools, your machinery that you're going to have to use to fix up the bicycle, so on and so forth. Those would be your assets. Then you'd have your liabilities, which are all these loans you took out to buy all these building and your tools, so on and so forth. And when you subtract all the loan money from the assets, what you're going to be left with after that is the equity you have in the business. So whatever's left over from the loans, that's your owner's equity, and that owner's equity should increase as you do business. Alright, if it doesn't, you're in trouble and you may have to close up shop and go bankrupt, and that wouldn't be a good thing. Alright, so what about revenues and expenses? Well, somebody brings the bike to you, you repair the bike, they pay you a certain amount of money to repair that bike, and that's your revenue. Well, what about your expenses? Well, you're going to have cans of oil to use to oil down parts on a bicycle. That's an expense. You're going to have replacement chains. Sometimes you're going to have to buy a wheel that will replace the wheel because the wheel's so badly damaged that you can't repair it. And certainly if somebody's seen a bad bicycle wheel, they know exactly what I'm talking about. So you'd have to buy a new wheel to put on the bicycle so that the bicycle could be sold, so on and so forth. Certainly if you're selling bicycles, you're going to have to buy a whole bunch of bicycles to put in your shop so you can sell them. So those would be expenses. So then you have your revenue, which is what the people are paying you, minus the expenses of what you had to pay to either fix the bicycle or to buy the bicycle from somebody else to sell to the customer, and whatever you have left is your net income. Alright? So Revenue is really your gross income, then you have your expenses, and then you have your net income. It's just like at home. You receive money from your paycheck, you have expenses, which is your food, your gas, your rent, so on and so forth, and afterwards you have your net income. Same thing in a business. Alright, I'm going to talk about more accounting terms and some other things in future videos, so stay tuned.